I'm Karl Kyler, your San Diego Realtor, and we're back with Matt.Kish from Movement Mortgage with the Karl and Kish Talks to update you on the loan side of the market. Kish, we finished out May. Give us an update what happened with interest rates.
No, what's crazy is since the last time we talked, interest rates actually took a little dip these last 2 weeks. And then the last couple of days, they bounced back up. So if you drew a line across the board from where we were at 2 weeks ago to today, we're basically at the same spot. So a little bit of movement to the worse these last couple of weeks, but they bounced back nice over the last couple of days. So hopefully keeping that trajectory going forward into this new month, and we'll kind of see how it goes. But again, just like May went, I'm not expecting June to be much different, at least with the start of things. It's going to be touch and go. It's going to be day by day, just kind of seeing news, what tariffs are going to do going forward, how world markets are reacting to different things. Big news out of Ukraine this weekend. So again, very volatile, just touch and go day by day.
Yeah, I noticed that we bumped up slightly below, bumped up slightly below. That does make sense. We bumped up just over 7% for like a day or a weekend. And then we kind of softened right below 6% or below 7% again. Oh my gosh, my words are all over the place. We came right below, back under that 7% mark, but it's kind of like you said, like 2 months back, it's kind of the same thing. So with that being the case, you said you're not expecting any change in the month of June. You're just kind of thinking that rates are going to stabilize and kind of stay in the same range.
Well, I actually think they're going to stick to the better just a little bit. I'm hoping for a quarter or 3/8 to the better by the end of this month, just with the way we're seeing the trajectory going with the inflation softening. We're looking better as the Fed wants us to be. And so I could see rates kind of going a little bit more positively these next couple weeks going forward, as opposed to negative. But again, some bad news will really sway the pendulum. But there's some jobs reports this week that I think could really help us out as far as interest rates getting a little bit better going into the month of June.
Yeah, in my recent San Diego Market Matters, I do like a quick market update, and it seems like bonds, tariffs, stocks, and the trade deficit are like just regular news nowadays. And it's just like, it's just repeat. It's like the same stuff over and over. What did Trump eat for breakfast today? Stocks went down, bonds are going up, and it's just back and forth. So I could see how rates haven't changed much, with CPI having reported really positively in the sense that the expectation was 2.2%. It came in at 2.1. We have that big report coming in on Friday, which you mentioned, the labor report. I am so surprised. It makes sense. I'm so surprised that the Fed is still expected to hold at their upcoming rate cut opportunity. And it makes sense with tariffs. They don't know where the impact tariffs are going to have. But yeah, if you don't mind, I'd like to just see what your thoughts are. This is kind of forecasting pretty far in advance, but I just want to hear what your gut is thinking.
Well, my gut is thinking, right, is we got to watch the 10-year and we got to watch jobs, right? Those are going to be two factors that are really going to sway anything in the rate market, as far as I'm concerned, right? So where's the 10-year going to go, and what's unemployment looking like? And for me, especially this week, it's looking like unemployment is starting to rise a little bit, and the folks that are already on these benefits are extending them out even further. So the people who are unemployed are staying unemployed, and there's more people that are being unemployed right now. So it's kind of a double hit, and I expect these numbers to kind of show it. But again, will the Fed do anything about it? It's data collection, right? Is there consistent months over months showing that this is the trend, this is the way the economy is going, this is the way jobs are looking, this is the way unemployment's looking, this is the way inflation's looking, right? So the consistency in these numbers will help the Fed make a decision for lowering the rates.
Yeah, it's so interesting. I'd like to bring this back from our last Karl and Kish talk. You mentioned how the Fed is always responding, they're always basing their decision off lagging data. So they're probably going to want to see the consistency in the labor market, even though like inflation's getting there-ish. We're just not having a really reactive unemployment jump at all. Like surprisingly, we're just sitting in that low 4% range. which is pretty good historically. Is that right?
Right. It's where, you know, we obviously we want to be at zero, but that's not the reality we live in. But 4 is a healthy number. But if we start moving towards 5, where I think we're going, that's when we're, you know, somebody's really going to have to look at it and make a decision on where we're going with monetary policy. And that's another thing too, right? Is with this new presidency is new economics, and the Fed really wants to see what's going to happen with these policies and what they're going to do with our economy going forward. And they're not going to be hasty. They're not going to jump to their hair triggers. That's just not something that Jerome Powell is going to do ever, and we can't expect him to change overnight. And that's just the way it's going to be. Is Jerome Powell's a lawyer and not an economist, and so he's going to be very, very diligent in the way he goes about doing his job, and that's going to be with data. And the only way to get the data is to look at it over time. Yeah,
I have to say, all things considered, the 2 mandates for the Federal Reserve is 2% inflation and maximizing unemployment. Goddamn, they're practically there, you know? So let's go ahead and just move into the next question if you're ready for it. You mentioned we need the 10-year to come down. That means we need more people to find, and step in and help me if I'm off. We need more people to seek security in the 10-year Treasury bond. To buy those, that brings the cost down. Interest rates, mortgage interest rates will then follow. Is that correct?
Right. So where do you take that money from, right? You take that money out of the stock market, right? Where it's kind of day by day and it's a little more up and down. And you want to take it and put it into something more secure. And you put it into a 10-year Treasury, right? That way, you know it's there, you know it's secure, it's going to make its money over time, and it's not, you know, you could lose it over one day of a bad market, right? So if you see the economy struggling and you want to put your money into something safe, that's where you start moving your money into the treasuries, and that's kind of the trend that it's going for, right? Or hoping for, and it's that what we were talking about a couple weeks ago. It's keeping that pendulum balanced, right? If the stock market's up, usually the bond market's down, and if the bond market's up, usually the stock market's down. So it's taking the money, putting it into something a little more secure over a longer duration of time.
Got it. Okay. So that begs the question, what needs to happen to drive consumers to want to invest in the 10-year over the stock market? It seems like from just our talks right now, unemployment would have to get significant.
Well, it kind of seems like it's happening right now, right? You see the economy kind of slowing down, right? And people are a little more hesitant. What does that hesitancy bring? Is they want to make sure their money's secure. They want to hold on to their money as long as possible, right? So what does that mean? Is maybe they're slowing down and buying less big ticket items, they're not building the ADU. They're not going to go buy a boat. They're not buying the motorhome. They may be putting that money into a 10-year treasury, making sure it's secure for a little bit because we don't know what's going to happen. So that's kind of the trend that we're hoping and kind of seeing. But we'll see. Again, the news cycles and the data cycles will tell the tale.
Yeah. So instability and uncertainty is what will
take the money out of the stock market and put it into the bond market, right? Is you want to make sure it's secure, and with the uncertainty, that's kind of the hope for the bond market. Is like, hey, people are uncertain; they're going to take it out of their 401k and out of their stocks and keep it into something a little more secure for a little longer duration of time.
Yeah, I can imagine if they see their, Tesla or random, Bitcoin or quantum computing stocks that they bought based off of a TikTok video, they start to see that plummet, they're going to probably sell, get their money out and try to invest it in some type of security, a bond that will recover some of their losses, hopefully. And then they'll probably forget about it and let it sit there for God knows how long until they finally recover.
Right. Or not lose it at any rate that they've been losing it before, with the stock market, the volatility and their 401ks tied to it. They're seeing major losses one day, major gains the next day. And so for some security, maybe you might want to put it into something a little more secure, like a 10-year bond.
Yeah, totally makes sense. Absolutely makes sense. All right. So this is the next direction I want to go is we're seeing data come back that we're seeing a shift to a buyer's market. and this is purely based on Redfin's report, which I just covered in my San Diego Market Matters. So if you're watching this video and you want to know more about this, check out my most recent San Diego Market Matters. I think that posted on June 1st. Redfin's reporting that, I think if I remember correctly, it was 31 out of the top 50 metros are now a buyer's market, and San Diego is one of them. Now, San Diego barely makes the list. They suggest that buyers outnumber the number of sellers by 14%, where Miami is like 198%. So I think what's happening is, as I'm in the field, and so I'd like to hear what your side of the conversation is with consumers. As I'm in the field, buyers are just, they're so much more conscientious of that payment now, where before, it's not that they weren't aware of the payment, they were like really trying to cash in on the rate. They're like, the rates are low, rates are low, rates are low, like we'll make it work. Where now they're stretched. They're the cost of living is, is heavier. Let's just say that way, heavier. Paying $9 for a burrito from a taco shop is just ridiculous. You add fries to that and it's $11. Things like that are just compounding. And then they're trying to get into the market, and home ownership, fantastic step in the right direction for their investment future. But they're having to do it with 7% interest rates. And that's a tough pill to swallow. So how are you, what programs or how are you guys helping buyers to get into this market, especially if maybe you guys have some stuff on the horizons? Like if we're on the verge of a buyer's market, do you guys have anything in your back pocket or something that you're maybe bringing to the table to help these buyers?
Well, it's nothing new, right? But we're always trying to bring negotiation, and this is where dealing with our real estate partners and making sure the whole team's on the same page, right? Is what is your goal? What's your why? Why this house, or why this property? Why this condo? Why this townhouse? And what are we willing to do to get into this property, right? And going forward in our strategy is right now, especially as you said, it might be shifting into kind of a buyer's market, is seller credits. Is how are we going to utilize getting something back from the seller to make our payments lower in the interim, right? And it's the buy downs, the temporary buy downs, the 2-1 buy downs, the 1-0 buy downs, 3-2-1 buy downs, however you want to structure your temporary buy down. But right now, I am definitely not suggesting our buyers or borrowers pay any amount of points towards a permanent buy down. That's kind of throwing money to the wind if there's not a break even within the next couple of years, because we kind of know that we're going to be refining most of these loans anyway. So unless we're doing it on a temporary basis, I'm definitely not suggesting a permanent buy down on any loan that I'm presenting to my borrowers right now. But the temporary buy downs with seller credits is definitely something we're presenting right off the bat. It's like, hey, I know it may be uncomfortable at 6 3/4, 7% to get you into your first home, but this is what your rate looks like in 2 years, hypothetically, right? So I have software to show all of our borrowers any scenario that they want to see under the sun. So taking them forward into the future, maybe a couple months, what we're seeing, forecasting maybe for next year, if rates do come down X, Y, or Z amount, this is what your future payment looks like. Doesn't that look a little more comfortable than the loan that we're getting in today that we're really not going to stay in for any more than 24 months anyway? And showing them that comfort kind of going forward really instills to them their why. I really want this house, and now I do have a path of affordability, even if it's not today. In 6 months, 8 months, 12 months, we're going to really have that payment that we really want. And if we could just bite the bullet for a couple months, we're going to be okay going forward. Okay. And that's kind of the strategy we're implementing right off the bat. But again, it's all about the negotiation with the team, because every property is going to have its different strategy, right? Is it a tear down? Is it a new build? Is it something that is a flip? What's going on with the property? How could we negotiate the best for our borrowers going forward?
Yeah, I'll tell you, my experience in the field, it's hit or miss. I have clients that are are still having to compete with multiple offers on the premium properties. You know what I mean? And I don't mean premium by like the most expensive properties, but the ones that are just in absolutely beautiful and stunning shape, like just meticulously cared for. Buyers are like, are losing their marbles to try to secure these properties. So for the audience that doesn't know, because I do know, can you walk us through what a 2-1 buy down is, what you mean when you say this is a better strategic move versus a permanent buy down?
Right. So a temporary, let's just take the 2-1 as a general buy down, but all the temporary buy downs are kind of follow the same rule, right? 2-1, right? So you're going to get 2 years of a 1% break on your rate, right? So if, for instance, if today your rate is 7%, that's what we're going to qualify you with, right? So if we're doing a 2-1 buy down, we're getting the seller to give us credit to do this buy down for you. We're prepaying interest upfront. That's what a buy down is. We're prepaying interest upfront to give you a lower rate for this interim duration. And look at the 2-1 as a 24-month period and not so much a 2-year period, right? So in the first 12 months, your rate will be 2% lower than your qualified rate. So the first 12 months that you're going to pay on this loan, your rate instead of 7 is going to be 5%, right? And that's going to help tremendously, especially depending on the loan amount, right? It could be upwards of $800 for the first 12 months, $1,000 for the first 12 months in savings than what you would have had, right? And then going into the second 12 months, your rate's going to be 1% higher than the first year, but still 1% lower than your qualified rate. Your second year will be at 6%, which will still give you a tremendous break going forward and really ease you into this monthly payment. And by that time, by the end of year 2, we're hoping to refinance you in to the rate that you're currently going to be sitting at anyway, because A, you already know you're comfortable, and B, rates should come down hopefully 1% by then. That's kind of what we're hoping for. So 2-1 buy down is nothing more than taking seller credit, temporarily buying down your rate 2% for the first year, 1% for the second year, and then after that expires, you're moving into your qualified rate.
Okay, so what is the value of going with a temporary buy down versus a permanent one? Like, why wouldn't someone just fork out the bread to buy down their rate to 5% permanently?
Because, to get to 5% permanently right now, is gonna cost you a little more than 2 points, like right off the bat. To get down 2% right now is probably going to be closer to 5 points, right?
Oh,
so that's,
wow.
Yeah. So it's not always tit for tat, right? To buy down your rate, a point isn't always going to cost a point. It's probably going to cost a lot more than that on a permanent basis. And so whenever you're buying down a rate, either temporarily or permanently, there's always got to be a break even for this, right? We got to make sure that we're going to recoup this money somewhere. And knowing that in the next 12, 24, 36 months even, we're going to be refinancing these loans. We are. Interest rates are going to come down to a point to where we're going to have to refinance. And if you're going to be paying 5 points, 6 points to permanently buy down your rate, will you ever recoup that money in that savings? And the answer right off the bat is going to be, you'll never see that money again. You're never going to recoup it. So it's a bad business decision. It's a bad money decision to just put money at something you'll never see. You'll never get recoup the gains for. So, and again, with this software that I was talking about before, I could show you all that is where's the break even? Where does it make sense to permanently buy down this rate? And right now, there's really not a spot where I'm just like, go throw money at that. You might as well save the money, get new windows, get new flooring, do other things, because you're going to save that money in the near future.
Last note, just for the audience to know, if there is a rate buy down, and help me if I'm off. If there's a rate buy down, they prepay that interest. If the rates drop and there's a refi done during that period, you can recover some of that credit back towards the refi, right? Either a principal pay down or maybe a closing cost adjustment.
It actually goes directly towards the principal of your next loan, right? So say, for instance, right, hypotheticals. So we're doing a 2-year buy down, temporary 2-1 buy down, and it's a Think of it as a 24-month period. And in the 18th month, we refinance. So you're going to have 6 months of credit that you didn't use towards that temporary buy down that gets taxed and deducted off the principal of the next loan.
Beautiful, beautiful. Well, Kish, thanks for joining us this week. If you have any thoughts, questions, concerns, or if you're looking for a refinance or a loan, I have Kish's contact info in the description below. He's my preferred lender. I've known him for years. He's absolutely phenomenal. He will walk you through the process to educate you with confidence and comfortability so that when you move forward, when you're ready to make that first step, you're going to be very confident. You're going to know exactly when to make the right move. And it's going to be, Kish is going to be by your side, educating you along the way so that you know how to do so. Thoughts, questions, concerns, don't hesitate to reach out. As always, I'm Karl Kyler, your San Diego Realtor. We'll see you in the next video.